Afternoon, everyone, and welcome to an exciting session. We have the first session this afternoon on digital assets. There will be others following, and we'll try to address 4 questions for you. First, what institutional adoption of Bitcoin really means for investors. Then moving on to a little bit to the fiat world and some of the problems that we're facing, and maybe how central banks could evolve given where we are today. Then a little bit of a one-on-one maybe on how Ethereum differs to Bitcoin, and also what the grand new emerging world of decentralized finance brings us. We will only be able to scratch the surface there, but just to get you started on this a little bit, and then end with really asking the questions, why or should family offices take crypto seriously? And if so, why? And what could be some of the best practices as you start looking at this space? As Alex mentioned, I will be your moderator today. I'm Matthias, one of the co-founders and group CEO of Sygnum. We are a digital asset technology group with a banking license in Switzerland and asset management license in Singapore, really fully focused on providing institutional investors fully trusted access to this new emerging asset class across cryptocurrencies, asset tokens, and stable coins. And I'm superbly excited to be on this panel with my colleagues here, all of which don't really need an introduction, quite frankly, but still would like to kick off by giving everyone a quick, a few words to just introduce yourself, and maybe end with your one-sentence answer to what Bitcoin is for you. Maybe kicking it off with Raoul. Raoul, can you hear?
I'm the CEO and co-founder of Real Vision, and I also write and publish the global. Yeah, I can hear you.
Perfect.
Can you hear me?
Yes.
Yeah. You can hear me now?
Yeah, you're there now.
So I'm the CEO and co-founder of Real Vision, and also the publisher of Global Macro Investor, a kind of institutional research service. Bitcoin for me is the future.
Shop and Chris, thank you. Patrick.
Hi, everybody. My name is Patrick Tan. I'm the CEO and General Counsel for Novum Alpha, a digital asset quantitative trading firm. We've been in the business for the last 5-6 years. Basically, what Bitcoin means to me, it means freedom. Freedom, that's what it does.
Thanks, Patrick. Michael.
I'm the CEO of MicroStrategy. Bitcoin to me is monetary electricity. I think it's the most powerful technology of the 21st century. And it's going to make the economy run faster, cleaner, stronger, smarter, longer.
Thanks, Michael. And finally, last but not least, Peter.
Hi, I'm the Chief Executive of Aaro Capital. Aaro Capital opens up the exciting and rapidly evolving DLT in the crypto asset growth story for sophisticated investors via a regulated international fund of funds. And to me, Bitcoin is the eureka moment, which is leading to the next generation value-based internet.
Thank you. So let's kick it off with the first question we want to address, which is there's been over the last 12 months or so a little bit of a backstage to main stage moment for Bitcoin again, and I think in a fashion which we've not seen before, at least in the institutional investor space, which has also led to a significant rally on the price side, about a 10x since last March. And Michael, I would like to kick it off with you. You were one of the first, at least as CEO of a publicly listed company, who has been very open about, look, I want to use Bitcoin as part of my treasury portfolio. I'm going to significantly invest in it. You started with, I think, right now your portfolio, MicroStrategy's Bitcoin portfolio is worth around 5 billion. Today, a bit of volatility, but we're in it for the long term, right? So, but wanted you to start it off by just giving a little bit of an overview of the rationale that has led you to this decision to actually use Bitcoin as a means of adding it to your treasury portfolio.
I think that in March of 2020, the cost of capital tripled. Traditional treasury asset strategies that used to yield 2 or 3% went to 0. And the risk-free rate went from 6% to 20+%. I think our money supply expanded 24% last year. I expect that the money supply will expand at 20% this year. the most optimistic view is it went 24 to 20%. Maybe it'll go to 15% expansion the following year, and it'll be about 15%. So the money supply is expanding at 15%. Treasuries are yielding 0. Cash is yielding 0. The negative real yield of any cash or cash equivalents or short dated treasuries is minus 24% this year, minus 20%. Well, minus 24% last year, minus 20% this year, minus 15% next year. So the reason that we discovered Bitcoin is we all of a sudden had a massive problem. It was triple or quadruple the problem that we had had in the previous 10 years. Instead of a 6% cost of capital and a 3% yield on treasuries and a minus 3% real yield on a conventional treasury strategy, we went to a minus 24% real yield on a treasury strategy. So that shocked us out of our complacency. That caused us to go on a search to find a store of value. We sifted through everything. We found Bitcoin, and we found Bitcoin is the solution to the treasury problem, generally for any company, I think.
Thank you, Michael. And maybe in a related fashion, Raoul, moving on to you, you've also recently said that rarely, or actually the first time in your career, you've seen an asset, or this specifically Bitcoin, seen draw such significant interest from mainstream institutions. And also recently, I've heard you say that even for you, the way you now look at things, you want to own as much as possible of this new world, which is not just Bitcoin, but just the whole more decentralized infrastructure as well. Just talk us through your rationale. What are the key drivers for you to make such statements?
Firstly, the expected future returns of most asset classes are pretty low right now. Now, I understand that there are some disruptive technologies that may allow some parts of the technology area to grow faster, but generally the expected future returns of most assets is almost negative. Sure, you could pick a commodity that may have a future expected high return, or maybe emerging markets, but everyone's faced with that. Everyone's faced with a problem with their portfolios. You've been given a new asset that is uncorrelated, is highly skewed to the upside, and truly represents an answer to all of the problems of the global financial system, of which everybody's acutely aware of. So why would you not have that asset? And that has resonated very quickly amongst the investment community. The first guys that I were aware of were all of the hedge fund guys that I kind of grew up with. They all owned it in their PA first. Then they got it across the line. They started investing in their funds, and then the traditional asset managers started seeing these guys, so did the family offices, and everyone started following suit. But essentially what I think is going on is we have this broken financial system with low expected future returns. We have this entirely new world that's just being developed. And what we're seeing is a gradual migration across, and that migration will turn into a stampede. And it has to happen, because all the solutions here, the only solution they have is to do more of the same, which is, to Michael's point, just devalues money.
Yeah, then I'll pick you up on this point in a later stage as well, to go a bit deeper on this one. But Peter, anything that you've heard from Michael and Raoul, anything you don't agree with, or if you agree with everything, anything that you would like to add or stress?
So I come from the kind of very traditional economics background, particularly industrial and competition economics. And I mean, there is kind of a lot to be desired in the financial, still to be desired in the financial system. The payment rails, it's literally quicker to kind of put money in a briefcase and fly to France than it is to kind of transfer it electronically, which is a bit crazy. And our view is we don't see everything shifting over to this new space, but more kind of working alongside. Each system has the pros and cons, and depending on the situation, you pick essentially the lesser evil.
Lesser evil, yes. How about you, Patrick? Particularly also anything you don't agree with that has been said.
I think that when it comes to things like, and I've written about this relatively extensively, I think that when you go look at the data in terms of inflation, some of the stores of value that we're looking at, with respect especially to things like gold, Now, if you track gold's properties as an inflation, I think that as an inflation hedge, I think if you go all the way back to when the US abandoned the gold standard in 1971 under the Nixon administration, that's when you had this decoupling between fiat currency and any particular hard asset. And I think for me, that was sort of like the inflection point as to how much could governments get away with, how much of the damn stuff can they print before it starts to become worthless. Oftentimes, the argument that's leveled against why not Bitcoin was simply because it's not backed by anything. Okay, you name me something that's backed by something, then name me a fiat currency that's backed by something other than the promise of a government not to print so much of the damn thing that it becomes worthless. So I think that every generation is able to find a new asset. I think that with gold, it took about say about 18 years before it became fully formed as a proper asset class. We often get a lot of clients who say, you know what, are we a bit late to the whole Bitcoin game? And I stress that you're probably not. The fact that we still have to have this debate about whether or not Bitcoin is of any value at all, I think that suggests that it's still immature as an asset class. I think that we have these levels of volatility that we see on a day-to-day basis. That suggests that it's more an argument of narratives. It's not been established as an asset class. People always point to the fact that gold, it's still a physical asset. But seriously speaking, it has limited industrial uses outside of jewelry. So I would say that every generation sort of like finds its way through to a new asset class. I'd say with Bitcoin, the same way with like data, the same way with data analytics, and that will be the currency of the future. And it takes time for people to get used to that. You don't expect them to adopt it overnight. And I think we're kind of past that point, right, where I'm not the sort to like commit to a price prediction. So don't ask me what Bitcoin is going to be like at the end of the year. I have no clue. Your guess is as good as mine. But I actually don't want to look so much at the dollar value, because if you're looking at the dollar value, you kind of lost the point. Because then you're still measuring and valuing the resources of this life in dollar terms, when in reality, I think the things that we will value, say 2 decades, 3 decades from now, are going to be vastly different from what we see of being value right now.
Yeah, so if there's one thing that everyone agrees here is that there is a problem with the today's fiat system is broken, or at least there's lots of questions to be asked. Number one, and obviously more and more people asking this question or coming to that conclusion has also very much been driving the last 12 months adoption of Bitcoin by institutional investors. And if we look at just recent moves by central banks, by governments, US is a case in point. 1.9 trillion bill was passed. I think the Democrats are working on a 3 trillion bill now again for infrastructure and renewable energy investments. Question is, where does it end? And you, Raoul, you've basically framed the case that Bitcoin is the life raft against the debasement of traditional currencies. And now, but let me ask you the other way around. If you put yourself, given where we are, ceteris paribus today, the status quo we are today, and we know what's happening, if you put yourself in a central banker's shoes, what would you recommend them to do?
So just want to go back to a point about the Bitcoin backed by nothing. I mean, I think Michael makes the point a lot. It's electricity, right? People don't get their heads around the fact that that's what you're doing here. You're basically using electricity to create a future financial value transfer system and all of the things that come off it. So it is backed. We're used to a world of petrodollars. That's the world we live in now, essentially. So there's a bunch of different things. In terms of what central banks can do, given the nature of central banks and given the nature of the crisis, I think I would have done the same. What would a forward-looking central bank do? They need to look at money itself. But we're not there yet. They just don't want to go there because they lose control of their own money if they do. But that's what has to happen. They know the problem. The problem is we're in a debt super cycle driven by, the abuse of money, essentially. And that won't go away because they're incentivized to continue the same game, because there's nothing like disrupting yourself, which they don't want to do. So they'll go half-assed towards it, which is central bank digital currencies, but that's missing the whole point.
Peter, want to ask you the same question. Put yourself in the central banker's shoes. What would you do?
Yeah, I mean, pretty much what I've done. One place where I probably deviate a lot from kind of most of the rest of the panel is while I see there's still a lot to be desired in the financial infrastructure, fiat money itself is working largely as it should do. Like there is a constant complaint of fiat money inflation or currency debasement. However, there is an inherent trade-off between the store value and medium exchange functions of money. And if an asset appreciates by more than 4% a year, it uses liquidity as people start to hoard it. And the primary function of fiat money is as a medium of exchange and also as a kind of monetary policy tool to help ease the effects of money, economic shocks and the business cycle on the real economy. And overall, the fiat money fulfills this function relatively well, as long as governments aren't kind of careless. And fiat money, even though over 20 to 30 year time period, it halves in value, it still is able to kind of hold its value in the kind of time periods that matters to be used as a medium of exchange. And if you want to hold money 5, 10, 15 years, you should be kind of invested in kind of productive assets as opposed to holding cash, because there's this inherent trade-off between medium of exchange and kind of store of value, and it's deflationary value, given that prices are nominal prices, particularly people's wages are very sticky. When you try and kind of deflate prices, as what happened in the European periphery, in the European debt crisis, or there's a mismatch between the local economy and the currency, for example, in the kind of Rust Belt in the US, the economic reality of that is very painful when the price level can't adjust and you don't have a central bank to kind of smooth over these economic effects. Though that said, this technology and together with cryptocurrencies can massively improve the current financial infrastructure, and there's a lot of inefficiency and additional costs there that can be stripped out.
Thanks, Peter. And moving on to you, Michael, you've laid out a number of figures in your initial statement, but one of the key statements you've made again and again is that CPI is the wrong measure for inflation, and that in the current environment, if you want to at least keep your purchasing power, and Peter indirectly referred to it as well, you need to beat the 15% or so return annually. Can you just go one level deeper, starting with why specifically is CPI not the right measure of inflation?
Well, I think if you're an engineer and you wanted to solve a problem in aerodynamics or hydrodynamics or build any machine, you'd have to use vector calculus. So the right way to model the economy is a multi-dimensional vector that describes inflation plugged into a system of differential equations. And this is actually what I did at MIT and what I did when I created sophisticated economic models after leaving school. If we focus in on inflation in general, I mean, a reasonable way to track inflation would be keeping track of the price of every product in every place in every period. And every product would mean an array of every good, every service, and every asset. And if you tracked the price of residential housing in every postal zip code and the rate at which the price changed or the price change every day or every month everywhere in the world, you would have a reasonable representation of inflation. And everybody with any insight knows that the price of housing in the Magic Mile of London or Manhattan goes up at different rates than the price of housing in Kansas. And the price of housing on land in Miami goes up at a different rate than the price of condos in Miami. And the price of assets goes up at a different rate than the price of Domino's Pizza. And the price of really good healthcare that your insurance doesn't cover goes up at a different price than the price of healthcare that your insurance does cover. So the problem with a CPI is it's a scalar, and scalar means you're using arithmetic, like literally you're using arithmetic to run the economy, and there is no mechanism, there is no engineering achievement, there is no piece of technology on earth that can be created or solved using simple arithmetic and scalars. Everybody knows you have to use calculus of variations, vectors, you know, et cetera, in order to do this. And so that's why I say it's just a misleading number. It's almost defined to be deflationary. We created a basket of things that will never go up in price, and we track them with a slavish devotion.
But you reckon, Michael, that could be possibly deliberate, right? Because I mean, if you are a regulator, if you're a central banker, that's the kind of number you want to point to. So that gives you the excuse. Like, for instance, you know, it gives me, like, if I was a central banker, for instance, and I wanted to point to the fact that, look, you know what, guys, inflation is not something that we need to worry about. Let's just keep printing the damn things. And I think that, you know, I'm pretty sure that, you know, Jerome, Yellen, and the rest of them up there, they definitely know, as you do, that you have to use scalar vector quantities to actually properly track inflation. And they know it. But the point is that you don't look at figures which are convenient for you, especially if you have got a different agenda.
Yeah, like in the last 48 hours, I've seen someone say that housing prices were going up 5%. I saw another thing saying all US housing is up 11% year over year. I saw the CEO of a housing company on television saying the housing price is up 16% year over year. And I saw politicians and central bankers say that the CPI is 2% and it includes the cost of housing.
I was like, and how does that make sense? I mean, even if you were to take arithmetic, that wouldn't make sense.
And the cost of housing in Miami is up 20%, and in Palm Beach, 29%, and the Hamptons is 50%. So you could pretty much, and the answer is obvious. Some housing is more desirable than other housing.
Yeah, absolutely. I mean, you might not be familiar with Singapore, but I mean, if you want that, you know, that beautiful mansion down in the spine of Singapore, which is like the Bukit Timah area, you're gonna pay, you know, top dollar for it. It doesn't matter what time of the year it is.
Yes, and that's why maybe, and I think you've posited that, Michael, maybe CPI is very individual, right? For you, it's different than for me and for others. It's basically what is the composition of what you need in the future. Some may need a house in the Hamptons, others not, etc., or have the ability to buy it. So CPI is actually not the same for everyone. But we need to move on. But for the audience, if you have any questions, feel free to start typing them in the chat, and we will see that whether and at the end we have some time to capture some of them, particularly on this question. I'm sure there's many, but I would like to move on to the third question you want to touch upon, which is basically there's obviously not just Bitcoin in the world of cryptocurrencies. We have thousands. The second largest is Ethereum, which also over the last months has been very much making headlines, particularly for its usage in decentralized finance infrastructures. DeFi has been booming. Right now, we have around 44 billion USD locked in DeFi applications, and Ethereum is the key protocol on which these applications are built. Now, we will really only just be able to scratch the surface. We could do 2-hour session just on this, but just for the audience, Patrick, can you please start us off by just giving us a little bit of a overview how Ethereum is different to Bitcoin, and secondly, what for you, in short, is decentralized finance? What does it mean? How do you define this phenomenon that we're seeing?
I mean, on a technical level, Ethereum is different from Bitcoin because it's Turing complete. So as a blockchain itself, the programming rules that it's built on is just it's different from Bitcoin. So Turing complete, if you can Google it, but basically it just means that it's a kind of repetitive definition, but basically any Turing complete machine can then replicate itself on the Ethereum blockchain. But what makes Ethereum perhaps a little bit more special is that you can write smart contracts on it. Not to say that you can't write smart contracts on Bitcoin, it's just that it's slightly, I wouldn't say easier, but it's just different on the Ethereum blockchain. So when it comes to things like DeFi, essentially what it is that it's taking the argument of removing the trusted intermediary to a different level altogether with DeFi. So what you have is that, you know, anybody with any pool of cryptocurrencies, be it a stable coin or like a DAI or whatever you have, you can become your own sort of bank and provide a loan. What we've seen in the DeFi space right now is that it's still relatively immature. So that's why you've had to over collateralize your loans. So let's say if you wanted to borrow, say 100 ETH, you'd have to maybe put out 120 ETH and that kind of thing, so that, you know, the interest payments are built in. If the other party should default for some reason, you can claim the whole thing. We've seen trades, block trades, where you can do things like you can borrow, make the trade on the arbitrage, return the borrowed ETH all within one transaction block. And that's what people are doing, and that's how you sort of generate, because people don't quite understand how is it that, you know, you can generate those crazy APYs on some of the Ether projects in the DeFi space. So that's what we're looking at. I think that's really, really early. Our company got into that sometime last July, last August, and we were really just researching the thing out. And what we're looking at, I think that as we go forward, what will happen is probably, things like, and I'm not sure if this will even work, but as your Ethereum wallet address develops a certain provenance, then, and you've been shown to be a regular a counterparty who pays back regularly, there might be somebody who take your credit risk on that. So let's say, if you had to over collateralize your loan under normal circumstances, if we check your provenance on the blockchain, somebody else might decide, okay, you know what, I'm okay to fractionalize and maybe slice and dice it almost like a collateralized debt obligation. And then after that, parcel that out, there might be people who'd be willing to be recompensed for that additional risk that they're taking. But it's so early days. We've seen a lot of scams. We've seen a lot of what they call rug pulls in the DeFi space, which is unfortunate, but that's so common in the cryptocurrency space. I've just gotten so used to it. I've become numb to it already.
Yes, it's part of the next frontier of innovation, which we've seen in 17 as well. But picking up on this, Peter, given what Patrick just said, and particularly how early it is, and also, subject to still lots of, let's say, also scam projects that are going on in such a hype cycle, is it possible, in your view, for institutional investors to get exposure to this trend nonetheless already today?
Some of the kind of numbers of the number of scams, for example, the 2017, 2018 kind of ICO cycle, an estimated 70% were kind of scams or next to useless. However, a large amount of money still went into kind of very good projects. And over the past few years, we've seen them evolve into usable infrastructure in this space, and also usable services which are now providing, for example, traditional financial services from lending and borrowing, trading infrastructure, and further. And DeFi has a huge amount of potential. Over the past year alone, it has grown from around $1 billion to around $50 billion in assets locked in protocols. And this presents some very interesting trading strategies for crypto hedge funds. With a focus on DeFi, there's yield farming that can be either market neutral or yield enhancing on the assets that are already owned by an investor or crypto hedge funds. There's collateralized lending strategies, liquidity mining strategies. So it provides a wide range of kind of strategies from which investors can profit from right here and now. Some are kind of enhancing kind of market returns. Others are diversifying strategies and independent from the market overall. And really are a lot of unique and interesting, quickly evolving ways to profit from this space for investors looking to enter this space or already in this space. It's just a case of having to properly identify and manage the risks, as they are very unique.
Yeah, so early, but via institutional professional firms dealing with it, there's a way to get access. Obviously, also right now in my team, I don't think there's many engineers and others who are not active in the liquidity pools, etc. It's a huge world opening up to everyone once you start checking it out. But for institutional investors, still a bit early. Raoul, you've said before that you believe that Ethereum could become bigger than Bitcoin. What are your 3 reasons why this could be the case?
I just want to reframe some of this. I think talking about DeFi is missing the point. It's like focusing on a micro aspect of what is the start of the digital renaissance age. Everything is going to change. It's not just how we bank, how we transfer money, how we store value. We're moving into a truly digital world of which everything around us will change. People need to start getting familiar with things like the metaverse to understand where this is all going. And across that, once you start creating a digital world where, everything from education to where people socialize is digital, where people store value, transfer value, create opportunity is all digital. That whole world is a very large world of which we now have this pristine collateral base layer, which is Bitcoin, which is phenomenal, right? That gives it the stability and the anchor point from which to build. But I don't believe that it's all going to end up on the Bitcoin blockchain, and it doesn't necessarily have to, even if it's suboptimal. I think it's a much larger space, and there will be a interoperability amongst protocols to create this digital renaissance age. And within that, Ethereum probably plays a large role. So, and I see it differently than I see the Bitcoin ecosystem currently. Again, that may change. We don't know where this is all going. It's organic. You know, it's driven by millions of people. It's not driven by one person saying we're going there. So where it goes is where it goes. But I think probabilistically speaking, it is a multi-protocol interoperable world with Bitcoin at the center of it.
Thank you. Raoul. Michael, will MicroStrategy also invest in Ethereum?
You know, our view is that, you know, Bitcoin is a treasury reserve asset, and it's $1 trillion. And that makes it the most stable monetary body in the economic universe. So we just went and borrowed $1 billion. We invested in Bitcoin. We'll wait for Bitcoin to flip gold. We expect to make $10 billion off of it. When I look at things outside, and I think that Bitcoin is, if you look over the last 6 months, the price is going up at 700% a year. If you look at liquidity on Binance, it was trading 605 million a day 6 months ago. It's trading 4,937 million a day. That's up, that's growing at a rate of 1,376% a year by a factor of 10. So the liquidity is exploding in Bitcoin. The price is moving up. It's stabilizing. If I look at innovation opportunities, I feel like there's 3 pockets of innovation in the world. There's crypto innovation at the base chain level, and that's what Ethereum is. And there's other crypto assets that are working on innovating in that level. There's crypto innovation at the layer 2 level, which is what Lightning is, or open source things on top of Bitcoin. And then there's a lot of centralized innovation going on at Square and PayPal. When Fidelity issues an ETF, when Morgan Stanley tries to sell a fund, all of these are innovations, big tech and finance and Bitcoin banking and crypto banking and centralized things. I think, look, you can just go borrow $1 billion, buy Bitcoin and wait 3 years and you might make 10 billion. That's financial, you know, that's just a financial play. That's a play. I feel like, to Raoul's point, we've got an explosion of opportunities, and you can decide that you want to focus in on the base layer crypto innovation area, or you can focus on layer 2 solutions, or you can just do more pedestrian things like ask yourself, if you're Fidelity, how do you plug into digital assets? And everybody's got their, you know, their opportunity. It's so big. So, you know, and you can build an insurance plan that's based on Bitcoin, and it would be 100 times better than every insurance plan in the world right now. Is anybody doing it? No. Could you make hundreds of billions of dollars doing it? Yes. It's just a different thing. So I would say hundreds of thousands of opportunities. No human mind can grasp every opportunity. It's going to be a competitive market, and who knows who's going to prosper and who isn't. I don't know, but Raoul would say the market will sort it out, right? And just let the markets be the markets, and capital will flow to wherever it's going to work. And that's part of the wonder of what's going on right now.
Hundreds of opportunities, competitive landscape. We have, the audience is about 150 family offices from across the globe. We've done a little bit of a tour d'horizon across Bitcoin, Ethereum, DeFi, what it means on the macro scheme, what the problems are with the Fiat, current Fiat ecosystem. Now let's spend the last 5 minutes, and I don't see yet major questions in the chat. So I would love to do one final round in the last 6 minutes to just ask you, okay, put yourself in the shoes of a CIO of a family office, single family office, or a multi-family office, or a principal. Why does the crypto space matter? Why should you get into the space? What are maybe some guidelines, some best practices that you would wanna pass on to them, and maybe your view on in a overall portfolio, what percentage allocation do you feel is reasonable for family offices to get exposure to this asset class? Maybe kicking it off with Patrick, I would ask all of you to just keep it to a minute or so, that everyone has one last round.
I think ultimately, if you're a family office or if you're an individual allocator, you have to look at the data. The data doesn't lie. If you take back the data from, and let's take out the periods where Bitcoin really did crazy rallies. So you know, like an Olympic diving competition, you got to take out the 2s, you got to take out the 10s. So if you look at the last decade or so, and if you looked at just a simple median allocation of 2.5% into any 60-40 standard portfolio of stocks and bonds, that would have improved your return by about 15%, increased your Sharpe ratio by about, I think, 0.48. So you would have had better returns with a very small allocation, about 2.5%, in a very standard 60-40 split with no additional things like commodities and stuff like that. You might have experienced slightly more volatility, but overall you would have come out on the other side a lot better. So I think anywhere between 1% to 5% of any family offices allocations. And of course, there are other ways to participate, of course, in the underlying asset without necessarily just buying and holding. I think buying and holding is great. I agree with Michael in the sense that, you know, you can look to it as like a long-term store of value. But then, you know, if there is that portion that is slightly skeptical about where is this thing going to end up, then there are also other ways for you to participate in the underlying asset whilst hedging those positions. So you could take a non-market market agnostic sort of approach where you sort of trade the volatility. One of the things that we can definitely be
Patrick, if you
of,
can keep it short, short so that the others,
All right, so yeah. So anyway, that's what I'm saying. But anywhere between 1 to 5%, 2.5% is probably a nice median.
Perfect, thank you, Peter. Your take.
Yeah. So as for the impact of DLT crypto assets to added it to a traditional portfolio, our analysis suggests that there are a number of key observations. The first is the outperformance of crypto funds relative to the crypto market overall. And the second is that there is ample evidence that to get the most of the allocation in this space, one should allocate up to 5% of the portfolio to DLT and crypto assets. A 5% allocation to crypto funds will, according to this evidence, again, approximately double the annual return, Sharpe ratios, or TINA ratio of a traditional investment portfolio and improve the maximum drawdown. And does all of this with a rather limited impact on portfolio volatility. And this is because a diversified range of crypto funds has a much higher return and a much lower volatility than any mainstream crypto index over the full crypto market cycle.
Thank you. Raoul.
Well, I'm not the right person to ask because I've got 100% of my liquid net worth in Bitcoin and a bit in Ethereum and a few other assets. The point being is to frame it in terms of portfolio effects, particularly for family offices, is not that relevant. What you're deciding in a family office is, what does the world look like in the future, and what am I trying to transfer across to the next generation? This is the future. That's how I started this whole conversation today. It is the future of the entire financial system. It's the future of the digital world. It is the future of how we're going to transact in that world, how we're going to create opportunity in that world. And it's best represented currently by Bitcoin. So to not have a significant proportion of your portfolio and a significant proportion of your mind share is really missing the big picture. And I talked about this recently. We've basically just discovered America. There's a whole new world. And you can be the European saying, well, everything's going to remain the same. But it didn't. And it won't. And so that is what you have to do. You have to embrace this new world. So you need to be braver than you think you do. You need to ignore things like volatility, because volatility is just a function of return. And so you have to embrace the volatility and understand what it means.
Thank you. And maybe Michael, just that I've seen there's a question addressed to you, and maybe if you also in your answer in the last minute can also touch upon it. They say, Adam says there's a interesting point on innovation and the Binance liquidity point, Michael. How would one sell insurance at this time using a volatile currency like Bitcoin? I thought that was quite interesting.
Yeah, so my first response to generally any family office is everybody's under allocated to Bitcoin. if the risk-free cost of capital is 15 to 20%, that means the hurdle rate's 15 to 20%. Every cash instrument, stock, piece of commercial real estate, or bond has a negative real yield. You're destroying value with that entire portfolio right now. It's like clinging to a portfolio of bonds, real estate, and stocks in a country where the currency is collapsing. So the answer is you ought to be looking for scarce assets. The world's most desirable, highest quality institutional grade scarce asset is Bitcoin. MicroStrategy is 400% allocated to Bitcoin. We have 4x our capital. I would say you ought to convert all your stuff to dollars and buy Bitcoin. Then you ought to forward finance your cash flows, finance your fixed assets, and borrow as much money as you can and buy Bitcoin. And the reason why is because everything else is deriving its value based upon currencies, dollars, euros, yen, and they're all debasing at 15 to 20% a year. If they were debasing at 2% a year, it would be a very complicated portfolio allocation. If I told you I was going to collapse the currency at 30% a year, we wouldn't be having this conversation. The only answer is get your money out of the country. And so Bitcoin or a digital asset, a non-sovereign scarce asset is the same as moving your property into cyberspace where it won't be debased. So that's my view on that. If you don't like the macroeconomic argument, the reason to do it is because you have $1 billion block of encrypted sunlight. You can program it 1 million times a second. You can move it at the speed of light. And to Raoul's point, we're going to build the 21st century economy based upon encrypted sunlight that you can program. We're not going to build it based upon lumps of yellow metal, and we're not going to build it based upon paper that's losing 1% of its value every month. That's currency, but that's not asset. So, as for the other question, I don't have an answer to the other question. I think if you want to build, you can build insurance and you can build all sorts of complicated, interesting things. It's for specialists to do it, have at it. I have a simple idea, take money that's invested in assets that are deriving their value from cash flows that are debasing, and convert that monetary energy into assets, trophy assets, scarce assets, things that are not deriving their value from currency cash flows that are debasing.
Thank you, Michael. That's a great end statement. Our time is over. We could have, gone on for 2 hours. I'm sure. Gentlemen, it was a pleasure. And with that, and hopefully not too much delay, Alex, back to you. Thank you all for listening, and hope to be in touch with all of you soon.
Thank you.